Welcome to another episode of Money Matters. Today I'll be talking about a hugely popular topic that's called ESG, which is the environmental, social and governance factors when it comes to making investments. The decisions on where to place money into markets has always been based on several criteria, financial returns typically being the main one. Socially responsible investment, or SRI, was another factor, which is based on moral and ethical criteria and negatively screens out investment into firms in sectors such as oil, tobacco, firearms and alcohol. It wasn't until 2004 when a study called Who Cares Wins that ESG, or environmental, social and governance, really began to expand on SRI and incorporated other factors into the decision-making process, which suggested that ESG also had financial relevance. The Who Cares Wins report suggested that embedding ESG into capital markets makes good business sense and led to more sustainable markets and outcomes that are better for society. At the same time, the Freshfield report suggested that ESG issues are relevant to financial valuation. These two reports formed the backbone of the launch of the Principles for Responsible Investment, PRI, at the New York Stock Exchange in 2006, and the launch of the Sustainable Stock Exchange Initiative, SSEI, the following year. The PRI's role is to advance the integration of ESG into the analysis and decision-making process through thought leadership, guidance and engagement. The SSEI has grown over the years, and now many exchanges mandating the disclosure of ESG for listed companies or providing guidance on how to report their ESG. There was significant resistance to the adoption of ESG criteria by institutional investors in particular, as they argued that it was their fiduciary duty to maximize the benefit for their shareholders irrespective of other factors. However, as evidence shows that ESG can have a positive financial impact, the consensus has shifted lately. In important markets, ESG is increasingly accepted as a core part of fiduciary duty. One of the biggest barriers to universal acceptance, and still is today, is the lack of complete and transparent information. Corporate disclosure on ESG issues has improved since the launch of the Global Reporting Initiative, GRI, in 2000. Most of the world's largest corporations use GRI standards. More recently, the International Integrated Reporting Council, IIRC, and the US-based Sustainability Accounting Standard Board, SASB, has helped to advance the industry sector-specific reporting and relevance to investors. Overall, the quality of ESG information is advancing all the time, all the better for investors, corporate sustainability, and for the world as a whole. I deal with high net worth individuals, and I can see that the younger members of high net worth families have a strong desire towards utilizing their wealth and making a statement about climate change and sustainability. There's a considerable appetite towards impact investing, particularly green schemes, and towards companies that seek innovation towards a more sustainable future. No longer is absolute returns the number one topic of conversation. Millennials are the future, and the nouveau riche are putting their money where their mouths are. So let's talk about the E in ESG, which is environmental. So this really covers climate change and sustainability. This topic is huge, particularly for my younger clients. Thanks to the likes of Greta Thunberg, and more locally, fantastic NGOs such as Emily Lamb's Eco Drive. She's done a great job with Eco Drive. And it's really driving the message home towards governments and corporates to really make a change for the future. Here in Hong Kong, we have a green bond program that's it's a 12.8 billion USD bond program to raise funds that goes towards projects with environmental benefits. So huge program there. So the S in ESG is for social, and we're talking about diversity, human rights, consumer protection and animal welfare. Corporates have an ever more increasing pressure from the general public and stakeholders to consider these areas of their business. They mustn't abuse their power, but they have to ensure they treat their staff, the consumer, and really all living beings with fairness. They've got to at least portray this sense of care for these areas of the business. And finally, G is governance, corporate governance, and we're talking about management structure, employee relations, executive compensation, and employee compensation. I think this part has the largest significance to having a financial impact on the company. Having a good corporate governance suggests that the company has a better decision-making process, happier and more motivated staff, and really perhaps being best positioned to resist a toxic corporate culture. There's no denying that ESG is an ever-growing topic for investors. Cynics may argue that, oh, it's just a fad, it'll pass, but over the past couple of decades, there's been clear evidence that corporates are endeavoring to be ever more ESG conscious. And the cynics may argue, oh, you know, it's just a show, they're just playing this game to make their brand seem better. For example, Adidas, I think last year released a trainer that X% of this trainer was made from recycled plastic from our oceans. Huge, huge topic. And the cynics will say, well, it's just one trainer out of hundreds of other models that they make, and this trainer costs a small fortune. And I get it, and there may be some degree of truth in that. They're saying it's just a marketing strategy. So, you know, I get it, you know, there may be some degree of truth in that. However, the fact that they're going down this road and, you know, corporates are bending over to make these changes to at least seem more ESG conscious shows that they are responding. Now, if only the consumer would vote with their wallets and avoid plastic, or only buy cosmetics that do not conduct animal testing, or buy more locally, avoiding products that are shipped halfway across the world. But anyway, I digress. The fact of the matter is that corporates will need to be ever more transparent, and technology will aid this. Through freedom of information, the consumer and the investor will be even more aware of the negative effects of bad corporate practices, and will vote with their wallets and also put pressure on their governments to enforce changes from the top down. So I think finally, with the universal adoption of ESG and ESG becoming ever more transparent and universal in its methodology, the investor is increasingly empowered to put their money with corporates who have adapted to this new world of ESG conscious investors. Only recently, JP Morgan Asset Management launched initiatives to bolster its sustainable investment solutions, including a proprietary framework for ESG investing. They're also signing on to the Climate Action 100+, which is an investor initiative launched in 2017, which ensures that the world's largest greenhouse emitters are taking the necessary action on climate change. Also, Bloomberg and MSCI have launched 9 ESG high-yield indices in February this year. The head of ESG for MSCI stated that there's an increasing demand for ESG coverage and transparency. I completely agree on this. I can see that ESG is here to stay and will continue to grow, and more and more corporates will take this matter more and more seriously. Like I said before, particularly the younger members of high net worth families, they want to know that their money is not just making returns, it's going towards, for them, making a statement. It's part of their own identity of what their wealth is doing and how it's making a change for the future. So like I said, it's making a statement for them. And I build them a portfolio that's specific to their personal needs, including their ESG needs. And I will build something specific around them. It's tailored for their own particular needs. And, you know, ESG is not something to be ignored. This sector and the information and the flow of data for ESG from companies is going to be ever more transparent. We're going to see even more standardization of what ESG means for each company, and I think investors will be increasingly more empowered to really vote with their money and vote with their wallets. So watch this space. It's going to increase rapidly. It's here to stay, and I hope more and more corporates will really consider their ESG strategy in their corporate strategy meetings in terms of taking the company forwards. So thank you for your time. Thank you for joining me on this episode of Money Matters. If you have any questions on ESG, please leave your comments below. If you have any topics you would like me to cover in a future video, let me know in the comments. Please subscribe, give me a thumbs up, and I'll see you on the next episode of Money Matters.